Hello and welcome to Switzer Investing. I'm Peter Switzer, and today we look at some of the tech stocks that have been sold off recently, and we ask, is it buy time for the long-term investor? Now last week I looked at two tech stocks out of favour and another one hurt by the lack of Chinese tourists in a coronavirus world. And I asked, were these AAA stocks due for a comeback? And this chart on the screen right now shows you over the last 5 days, Altium, Appen and A2 Milk are heading in the right direction. 2 weeks ago, Adam Dawes of Shaw & Partners and Julia Lee of Birmingham Invest said they both liked Altium. Julia said she added it to her fund. Appen, on the other hand, was more like a hold, wait and see kind of stock. Now, the interesting point is, as I pointed out in those charts, all three are heading in the right direction right now. We will keep following those stocks to see whether the trend is something that's going to be endured and we start seeing a comeback of those tech stocks. Rickard will also then look at LICs, listed investment companies. And he asked the question, are these kinds of investment products on death row? We'll see why he's got this possibly negative view on LICs. So without any further ado, let's cross to Julia Lee of Birmingham Invest. Welcome, Julia.
Great to be here, Pete.
All right, Julia, let's talk generally about tech stocks before we look at a couple of individual ones. My feeling is, Julia, if you look at the big sell-off in the US and some of the sell-offs here, that eventually there's going to be a bit of a buying opportunity. Eventually the market will say there's still great companies, they're companies of the future. Is that a reasonable piece of thinking for the long-term investor?
Absolutely. I guess this comes down to the psychology of the market. And the fact is that people in the market overreact both on the upside as well as the downside. And the exciting thing is that that can create opportunities for longer term investors. So we're certainly seeing that in terms of the technology space. And I guess the question that investors are asking themselves is, where are they going to see the greatest returns over the next 12 to 18 months? And the answer has been value cyclical stocks. But now they've run quite hard. So looking at the outlook from here, I think it is going to be looking at those individual stocks and that stock picking, which is going to lead to that increase in return.
Okay, so let's move into, last time we spoke, you said you'd added Altium to your fund. It's done well since then, and in fact I showed earlier in the program 3 stocks that I wrote about, Altium, Appen and A2 Milk. They all actually have had a good 5 days. Of course, I never thought A2 would do all that well anyway, because it's got other problems, I think. But you know, they're all. I'm starting to feel as though people are starting to nibble on the basis that okay, they've got some challenges ahead, but the prices look really attractive. What's your feeling about? Well, I know you like Altium. What about Appen?
So Appen, I'm still a bit unsure on. The announcement that they came out with, that they were reconfirming their forecasts, was a positive, but they were also laying off a significant part of their workforce, which I thought was quite unusual because Appen has quite a labour-intensive business model. So if they're laying off people, I guess there's a question mark on whether they've been able to automate some of that business or whether their clients have been looking at automation of that business. And I suspect that their clients have been doing their own work in terms of AI, and maybe that's led to the not as great a need for that workforce. So Appen, I'm still unsure on. I just want to see a bit more clarity in terms of their business model and what's happening in terms of the market. But certainly Altium printed electric circuit boards, I think, is a COVID-19 recovery story. Okay,
we won't go to A2. I think until we get Chinese tourists here, we're not going to see a big move on that stock, or maybe even a takeover. EML was a company that you introduced us to. I've put it in the Z stock. It's done fantastically well. Then it's encountered this problem of the Central Bank of Ireland. Have you done any homework to see how serious this potentially might be, or potentially not be? I prefer the latter rather than the former.
Yeah, I mean, Pete, I like EML's business model, and this is an unfortunate hiccup that they've had some correspondence with the Central Bank of Ireland around their PFS business, which of course they just recently bought. So look, I think in terms of the Central Bank of Ireland and the license that they get through the Central Bank of Ireland, there's about, I think, around about 30% of revenue that goes through that license. I went back and had a look at the number of times there have been, I guess, public statements regarding licenses. And there's been around about 14 over the last few years. All of them, well, none of them resulted in any of the licenses being revoked. There were some fines involved in some cases. So look, the range of outcomes is quite vast here. Yeah. I guess the worst case scenario is that they would lose their license, and that would impact on around about 30% of their revenues. I think that's a highly unlikely scenario, depending on the type of breaches that were made and how many breaches in terms of AML and counterterrorism financing. It might involve a fine and probably some high compliance costs. But of course, there's a range of different outcomes here, from the worst case scenario to the best case scenario. So it's very hard to value the stock at the moment. But given that the loss of license is unlikely, and that's what the market's really pricing in, as long as you have a higher risk tolerance, there's probably an opportunity here because there is a lot of uncertainty in terms of the stock. Yeah. So look, I like the business model. Unfortunately, this does dent confidence quite a bit because, of course, they've only recently purchased that PFS business. But all up, in terms of the area that they're in, I think it still has some good growth prospects. But I think the next 12 months is really going to be about sorting out these issues with the Central Bank of Ireland to make sure that they're comfortable. And EML has come out to say, look, they're willing to work together. And I think that's a step in the right direction.
Yeah, so it's a fingers crossed opportunity, but you know, the market doesn't know. The market sold off, as you say. It was probably a nice bounce back after it dropped on the first day, but we are operating in the dark. Now, Julia, what other stocks have you come to like over the last week or so?
I've been looking at individual stocks and combing through a lot of stocks because we have seen a lot of themes, I guess, running hard, like the cyclical, the value themes. The banks have been running hard. So it's coming down to combing through individual companies and where there is value and I guess looking at the outlook as well. One company that has come up on, I guess, the interesting list is GrainCorp. Now, the share price has fallen from around about $5.60 to $4.80. They came out with some good first half results because we know that the East Coast crop is going to be excellent. But they've also said that the second half is expected to be better than the first half. So you're looking at a company with improving outlook, but the share price has pulled back from about $5.60 to $4.80. So around about these $4.80 levels, I'm happy to be accumulating. The other thing that we know is that the logistics business is going absolutely very strong at the moment. Whether we look at shipping rates across the globe or things that people are ordering, the consumer is very strong, not only here in Australia, but globally. So one company that has exposure to that, of course, is Qube Logistics, QUB. So that's one way to play that. And of course, there's a possibility of a capital return there as well with the recent sale of its stake in Moorebank. So look, that's another one I think which is an interesting angle. And the share price has pulled back a little bit as well. So look, from here on in, I think it's all about doing the hard yards and looking through individual stocks rather than themes, but also remembering that we are coming to the end of financial year. And that means that there could be some opportunities from tax loss selling. And this is where investors try and book in their losses ahead of the tax year. But sometimes in July, you see some of those stocks that have probably been oversold into the end of tax year, bouncing back relatively strongly.
Yeah, so you're saying that stocks that could fall over the last few weeks of June could then be bought back in July.
Yeah, so look, if you are interested in A2 milk, I'd probably wait until the first week of July before buying in, or even the last week of June, because it will probably be a stock that will be hit by some tax loss selling. Stocks like A2 milk, Parenti, these are stocks that have seen some pretty sharp losses over the last year. In fact, if we have a look at A2 milk as well as Synlat, they're both down about 40 to 50% just in 2021 so far.
Yeah, and so there are a lot of people, particularly people who've invested in A2 milk, lost a lot of money. They take the loss, they use it on their tax return, and they buy it in July.
Yeah, so I think this is an interesting time of year in terms of timing. So if you are looking at some of those value plays, I'd probably hold off for a few weeks because you'll probably get a better opportunity.
Yeah. It is interesting, Julie, because July, despite the fact we've often said sell in May and go away, July is actually a good month for stocks in Australia, isn't it?
July is a good month for the share market. Look, May's a hard month because 3 of the big 4 banks trade ex-dividend as well, so you're sort of coming across that. And of course, June there's the tax loss selling, but July tends to be a positive month for the Aussie share market. But at the moment, we're not far from all-time record highs, Pete.
That's right. I must compose a song called "Can't Wait for July." Julia Lee, thanks for joining us.
Thanks, Pete.
This episode was brought to you by WCM Investment Management, a California-based global equities manager with an outstanding long-term track record. This chart shows the significant outperformance of WCM's quality global growth strategy over the past 1 year, 3 years, 5 years, 10 years, and since its inception. Investors can access the strategy via the ASX with their choice of an exchange-traded managed fund, WCMQ, or a listed investment company, WQG.
Now joining me now is Adam Dawes from Shaw and Partners. Hi Adam, how are you going?
Really well, thanks Peter. Yourself?
Very good, mate. Now look, I want to get to the stocks you like this week, but I also am interested in what's going on in the tech space, because we've seen, particularly overseas first, some of those big tech names like Tesla down 35% or whatever. You know, the ARC Innovation ETF, it's copped as well after doing brilliantly, you know, in the year before. And of course, we know that when the tech stocks in America cop it, the tech stocks here cop it as well, and Afterpay has copped it recently. But we're starting to see a little bit of nibbling and a bit coming back. And my question, just generally before we start talking names, do you feel like, because of rotation, fund managers, in a sense, have to sell the ones they made plenty of money out of, but one day they'll say, well, the value stocks now look pretty pricey. These tech stocks look like reasonable value now. Is that likely to happen over time?
Well, I think we're somewhat seeing that now. You know, Commonwealth Bank getting up to $100. We're starting to see, you know, some of these value stocks that are potentially looking a little bit better going forward for a lot of things. So yes, I do feel that. And you look at something like an Afterpay or a Zip, these ones are actually sitting on the PEs that they were pre-COVID. So, you know, yes, they've had their run up. Yes, they've come back, and now it actually looks like it's doing okay. So I do feel that we will see a rotation. I don't think it's going to happen straight away. I think the tech names are still on the nose a little bit, but I'm really, really comfortable with a lot of the stuff that's happening in the tech space. And, you know, some of the numbers that these guys are going to be putting out over the next 6 to 12 months, especially in the buy now, pay later sector, I think it's going to catch the market by a little bit of a surprise.
See, some people think the buy now, pay later participants, namely Afterpay and Zip, will suffer because you've got PayPal coming to the market, you've got, you know, Klarna and all those other ones. But there's other people say, and I'd be interested to see what your view is, that the America in particular is a long way behind in terms of the take-up of buy now, pay later. And so as the biggies get involved, it'll actually get more Americans into it. And so Afterpay and Zip might actually have a smaller percentage, but a bigger number of people actually using their stuff. What do you think?
Yeah, well, we know that the US is only at a 10% penetration to the buy now, pay later sector. So and they are the biggest consumers in the world. So we will see some amazing numbers coming from Zip and Afterpay. Zip did actually just do what was called a quad pay day, where they basically, like Afterpay does, those special sort of days where they do a lot of shopping. And they actually came out with some fantastic numbers. You got to remember the share price has been moving up and down. But these businesses are doing business as usual, signing up merchants, signing up clients, and getting revenue in the door. So all of these things put together, Zip also came out today and announced that they're going into Europe by acquiring a couple of businesses. This thing is going to do well, and I think the quarterlies, will catch the market by a little bit by surprise.
Yeah, and who could argue that Nick Kyrgios zipping it isn't a great idea?
He's on the buses, he's on everything, isn't he?
I know. But when you ask the question, should I zip it? Everyone says yes, definitely zip it.
Yes, you can.
Okay, let's dwell into look at a few tech stocks that you do like. And I think last time we talked, you liked Altium. You're still on board with Altium?
Yeah, definitely. Altium has got that recurring revenue. That is what all tech businesses need, is that ARR, or annual recurring revenue. Altium definitely. Appen, I still think has got a lot to work out, and we still need to be a little bit cautious about that one. But I've been talking about Appen and holding Appen for the next quarterly announcement. That's when we're going to get a little bit more clearer indication on how this revenue and how those big boys are sort of starting to chop up their revenue and how they're going to cope with that. So yeah, hold for Appen. Altium is definitely a buy.
Okay. Now you've also mentioned here in your notes you sent me Zip is. You've already talked about Zip, so you like Zip as well.
Yeah, very much so. And I think with Zip, with that regulatory issue that potentially we might have from, the Commonwealth Bank or somebody wanting to talk about credit and understanding what's happening, I think Zip will do better in that environment. So that's my number one pick in the buy now, pay later sector.
Okay. Now, you've also got a liking for Wiser, WZR. For people who don't know what Wiser does, explain to them.
Yeah, so this is a little bit of a smaller one. So it's a speculative stock. So just be careful with that. And I think people need to be understanding of what they do. But basically, Wiser is a small neobank, or a bank where they lend money out to people online. So it's a very, very good business. But what's happened over the last sort of week or so, they've been able to squeeze the rate that they're getting those borrowing from the larger banks lower, which means more profit to their bottom line. So I think that's something that you really need to be cautious, not careful of, but to be understanding of it. Wise is a very, very good business. We've got a buy on it here at Shores. It's just been trading in a range, from 18 to 24 cents for the last 6 months. Now has just broken out of that range, 31 cents. And that's a real positive, because this stock has always struggled to get over that 24, 26 level. It is now broken out. Keep an eye on that. If it holds that level, this thing should go higher. Okay. So yeah, I like that. I like Wiser.
Okay, and in terms of your favourites, you say you still like CSL. This is
yes.
The safe side of Adam Dawes. You go on the high risk side in the tech space, and now you go in the very safe one, CSL.
Well, look at it today, up 6% or 5% today, up another $5. It definitely looks like it's starting to break up and get out of that sort of funk that's been in at sort of 260, 270 level. It's now starting to climb a little bit higher. They did talk about some of their blood collection agencies in the US and how they're going to combat that and get that revenue moving. I think the market's liking that. I think it's a good time to look at CSL again.
Okay, and another non-risk type play, Woolworths. Wow, exactly right. There's a couple of reasons why I like that. The demerger of the Endeavour Group, that's going to be a fantastic one. You have to be on the share register before the 16th of June. So everybody should write that number down, or that date down, 16th of June. But basically, they're going to be divesting their business, which is their alcohol, Dan Murphy's, and that business, which is the ALH, which is Australian Leisure and Hospitality business. That is going to happen. And I really like Woolworths for that longer term play. One, you get an extra stock in your portfolio. But two, there's about $2 billion that will come back to Woolworths, which means they'll keep the dividend nice and solid and maybe even do a capital return back to shareholders.
It's a buy.
Okay, and the last one here is NCM. Tell us about NCM.
Still staying in the safe space there is Newcrest Mining.
Yeah.
I think gold is now, if you look at the charts, gold's now starting to tick up a little bit higher with these inflation concerns and all the issues that are happening out in the world. Bitcoin's come off. Potentially now it's time for gold to have a little bit of a renaissance, time to shine. Newcrest is the big boy in the room and it's probably the best pick in the sector.
Yeah. I've always liked Northern Star and I've never ever got it at the right price. Very impressed with the CEO at Northern Star. What's your rough view on Northern Star?
Yeah, Northern Star is probably my second pick in that space, and I really do like the merger that they did with Saracen. I think that makes them potentially the second largest player in that gold space. I think Evolution Mining is getting a little bit left behind, so that's something to consider. But Northern Star, very, very good business, good management, and they understand their prospects very well. I own shares in Northern Star. I think it's a great business as well.
Adam Dawes from Shaw & Partners, thanks for joining us.
Thank you. Have a great day.
Well, joining me now is Paul Rickard, and Paul's got a view on listed investment companies. And he's not all that positive on them going forward, but I want to see whether he's just as negative about the ones that actually exist in the market right now.
Look, I'm not that negative, Peter, but it's about a year to the day since the Treasurer, Josh Frydenberg, announced the ban on the financial advisors and stockbrokers getting a placement fee. That is when a new company wants to raise money through a listed investment vehicle. They engage a lot of stockbrokers and advisors to help you invest in it, and they get paid a commission between 1.5%. Well, not surprisingly, since the ban came in effect from start of last June, there hasn't been a single new listed investment company. The numbers have actually dropped from about 111 to 102 at the end of April. So we've seen, a decline in the number of LICs and no new issuance in terms of new vehicles being started up. What is replacing listed investment companies are the so-called actively traded managed funds. They're things like we have for Switzer Dividend Growth Fund, or Magellan has for its Global Equities Fund, and a lot of the fund managers now have these quoted, effectively they're like an exchange-traded fund, but they're listed on the ASX, and they're actively managed.
Active means that people can pick the stocks rather than just following the index. But Paul, LICs have had a long tradition, and really good ones can make money. Like, for example, we know WQG was one that we've been linked to. It was trading at a discount for some time, but eventually it's gone into premium.
Yeah, there are a lot of really good LICs out there. I mean, and the great thing about LICs is they are companies, and the people who manage the money argue that's got a couple of big advantages. One is that because it's a fixed size and all the shares get issued, the manager doesn't have to worry about inflows and outflows, right? The capital's there for good. They don't have to worry about whether they're having a bad month and there's a few nervous investors out there or so forth. So the fund manager can get on with the job that he or she has to do. And the other advantage is that they've got a little more discretion around the payment of income, and so the companies can, stabilise and level out their dividends. They tend to pay higher dividends.
And they use franking credits.
And they use franking credits. So and a lot of them are pretty low cost. So the big ones are things like Australian Foundation, AFIC and Argo. They're all very, very low cost. But in those listed investment companies, I mentioned there's 102 now. About 80 of the 102 are trading at a discount, and only 20 are trading at a premium. Now, what that means is that where they trade on the ASX is below the actual net worth of the company.
And a lot of people don't get that, Paul. How does that happen?
Well, that's because because all the LICs, they're called listed investment vehicles because they're just buying shares in other companies, right? And all the assets they have are incredibly marketable, and they can be valued every day because if
the share prices are there,
the share price of the underlying components go up in a day, then so does the value of the LIC. So you can work out what's called the net tangible asset value, and that can potentially be calculated not only during the day, but also effectively in real time. Now, where they trade on the ASX, it's just where someone wants to buy and someone wants to sell.
So you mean to say, like, this could be a really good LIC with a really good fund manager who's doing really well, but the idiots who buy and sell don't recognise it and don't pay for it. From your point of view...
And conversely, sometimes the idiots who buy and sell it are paying way more than it's worth, right?
So some LICs are overvalued for no good reason.
Yeah, I mean, typically what it tends to happen is that the poorer performing LICs, which aren't as well marketed, they're often smaller, they tend to trade at a discount. And the better performing LICs, people like you mentioned WQG, where the manager's doing a really good job, that discount goes and they start to move towards a premium. Now that's not always the case, but there are some LICs that go between premium and discount, and things like Australian Foundation or Argo or Milton Corporation. They're examples of sometimes a premium, sometimes a discount. I argue that whenever something is at I'm sort of from the school that if you can buy something worth $1 for 80 cents, why wouldn't you? Yeah. But conversely, I don't like paying $1.20 for something that's only worth $1.
That's right. But also, what the critical thing is, if you're going to pay 80 cents for $1, a LIC that's currently on the market for 80 cents, but really is worth $1, you want to make sure it eventually closes, because then you get the annual return, the income they might pay you, plus that capital gain.
Yeah, and that's a really good point, Peter. Just because something is cheap doesn't mean it's going to get expensive. It could stay cheap for a long time, right? Yeah. And sometimes those discounts can last for years and years. Now, eventually, if they get that big, someone comes around and says there's an arbitrage here, or I can actually get in, I change the manager, and et cetera, and the market is rational. But it can be irrational, if that's the right word to use, for a long period of time. So you need something that's going to close it. Typically, what will close it is good, strong investment performance. So if you've got something, where the manager has a history of making good investment performance, eventually the market will say it's worth more, and that will tend to close it. So I've identified some LICs to buy and some others to sell. 4 to buy, 2 to sell. They're all sort of big names, and 3 or 4 of the ones are really, I think, of a really good value in terms of the manager and the investment performance, and a couple of the big ones that are trading at a big premium, I wouldn't touch. Not because they're not well managed, but just because I can't work out why you'd pay a lot more than they're
I guess sometimes people buy them purely for the income, but it means that they really are avoiding being in much better assets that could give you capital gain and income.
And you have to be a bit careful of just buying just for income, Peter, because sometimes, I won't say it's manufactured, but sometimes it can be. There are some accounting tricks, effectively, and you can see a LIC that's paying a really good income, and arguably you might say some of that, what's coming back to you is actually your capital, right? So you've got to be a little bit careful, but I think they're an interesting asset class, but if you're a holder of one of the big LICs, it's really worth monitoring the so-called NTA, the discount to NTA or the premium, understanding what the market thinks it's worth compared to what the assets are really worth, and that can govern a little bit as to whether you hold it or you get out or you buy more.
Yeah. So if you want to read about that, you want to understand LICs, go to the Switzer report. If you're not a subscriber, make sure you become a subscriber. That's Paul Rickard from the Switzer report. Well, that's the show for this week. Thanks for joining us. Don't forget, we'd love you to become a subscriber to our TV show, but also to be a subscriber to the Switzer report. We're all here to make you money, but occasionally we just have to make a little bit of money ourselves. Thanks for joining us. See you next week.